First, let's get something straight. The economy is all about the real world: jobs, wages, production, inflation, GDP, how people are actually living and working. The stock market, on the other hand, is like a big auction house where people buy and sell slices of companies, hoping they'll be worth more in the future. One is real life. The other is future bets. The key difference? Timing. The stock market doesn't care about what's happening today. It's always looking ahead, 6 months, even a year into the future. Investors are betting on what might happen, not what is happening right now. That's why you'll see the market rally even during a recession if investors believe things will improve down the line. Another reason they move differently? Big players. Hedge funds, institutional investors, algorithms, these guys don't operate on vibes. They react to earnings forecasts, Fed policy, geopolitical risks. Their moves can send markets soaring or crashing, even when Main Street doesn't feel a thing. Let's look at some real-life examples. In 2020, COVID hit, the economy shut down, unemployment skyrocketed. But after the initial crash, the stock market roared back. Why? Massive stimulus, low interest rates, and the belief that the worst was behind us. Meanwhile, small businesses and workers were still struggling. Go back to 2008. The financial crisis wrecked the economy. Yet, the stock market bottomed out in March 2009 and started climbing, even though unemployment stayed high for years after. Investors were betting on recovery long before the economy actually healed. Flip it around to 2022 and 2023. The economy was growing, jobs were strong, but high inflation and rising interest rates crushed the stock market. Investors worried about future profits, not current growth. So even with good economic data, the market suffered. What actually moves the market? 4 things. Interest rates. Higher rates make borrowing expensive, hurting company profits. Corporate earnings. If companies make more money than expected, stocks go up. Investor sentiment. Fear and greed move markets faster than logic ever will. Global events, wars, pandemics, supply chain shocks, they shake confidence. And here's a mind bender. Sometimes bad economic news is good for the market. Rising unemployment might cool inflation, leading the Federal Reserve to cut interest rates. That's bullish for stocks. Twisted, but true. So why do people still confuse the market with the economy? Mostly because of the media. Stock market headlines are loud, flashy, and easy to understand. Dow Jones hits new high. Sounds like a good thing, even if half the population feels like they're struggling. It's an easy but misleading shortcut. The truth is, the stock market and the economy are like two people walking a dog on a leash. The person is the economy, walking steadily. The dog is the stock market, darting around, running ahead, lagging behind, sometimes pulling the leash tight, sometimes slacking. They're connected, but they don't move the same way. So next time someone tells you the market is up so everything must be fine, you'll know better. They're related, but they're not the same. Don't get fooled. If you found this useful, hit that like button and subscribe. And let me know in the comments, do you think the stock market is in a bubble right now? I'll be reading your takes.